Uh, Hello guys, this is Jwarash. So I'm back with this continuation of my previous tutorials on NumPy, and today we'll be discussing about some of the arithmetic operations that you can do in NumPy. So yeah, NumPy is actually was made by some corporations which deals with stock market trading and all. So NumPy was initially made for stock market trading, but then it was hugely adopted by different communities, and yeah, because of its like easy use cases, and I mean it's really easy to use and really fast performant library. So it is used by almost every data analysts or data scientists for doing their kind of data analysis. And yeah, so yeah, let's get started. uh, okay, so okay, so I guess, yeah, so let's get started. So last class we discussed about rolling mean and median. So using that, we created some kind of bands, which is upper bands and lower bands. So what is the significance of that upper bands and lower bands? I already mentioned in the last class. If the stock price is less than the lower band, it is a buy signal, because the immediate next your price will go up. So you should buy your stock market when it is lower than the lower band, and when it is upper than the upper band, you have to sell it. So yeah, the problem in this is like we are actually watching these bands and then deciding by looking into it, but we want it to be so so if you see here, we are just watching it and then we are telling that yeah, we have to buy it and sell it, but actually we have to write some kind of function which does the similar kind of things for us. Yeah, for that we'll look into some kind of apply functions and all later on in this tutorial. But yeah, next thing is like what we're gonna learn is like some small terms related to stock markets. This next term is like daily returns. The what is daily return? Basically, daily return is the ratio of the price. So the formula of daily return is pretty simple. It's price of t divided by price of t minus 1 minus 1. So basically, the daily returns tells you whether the price is uh, I mean, is it a positive return or a negative return? Every day you receive some kind of returns. Yeah. So basically, what is the formula of that daily return? You take this price. Okay, we'll take this price, and then divide that with this price. Okay, and that will give you some kind of uh, amount minus 1. So yeah, that you will receive like as a daily return. So you can see that this price, so divided by t minus 1 minus 1. So what this basically gives you a ratio using which you can see whether the price is high or low, or like you can basically get an idea whether the stock performed in a good way or a bad manner. So yeah, that's the benefit of noting down the daily returns. And in stock market you will see all those daily returns in this displays. So you will see this kind of percentage and all those things, you will be there. So yeah, so let's compute this daily return using it pandas. So I will get started. We'll connect first. If you don't know how to use this collab, you can watch my previous tutorials in the channels. Or if the tutorial is not live, you can actually ping me. I'll give you the tutorials link. And yeah, so first thing you have to connect, and then you have to mount the drive. Okay, it's already mounted, so I don't have to mount ideally for the drive. And next thing is I have to import NumPy. Not required. I'll import pandas, and I'll read this SBI stock market's price. Uh, Data frame dot shape will give me the shape of that data frame, and you can see they had the or the data, or the you can check actually the data by doing data frame dot head. Now we'll compute the daily returns. How to compute the daily returns? We have to understand that. So basically, the daily return is the price of t divided by price of t minus 1. That is, if you're calculating daily return for this row, so you have to take the price of that row divided by this row price minus 1. So it's simple. You just have to do division and minus 1. So just take this price and divide by this minus 1. For this row, take this price, divide by this price minus 1. So that's how you calculate the daily returns. And to do it using the Pandas, you can use DF's shifting methods. So how do you shift? So you can see you can use df.shift for shifting it by 1 unit. So how to use the shift method? I mean, if you are doing so for example, you want to shift this one top, like this one top. I mean, you want to shift this row on this row. So you want to just convert the index values from 1 to 0. So basically, you just remove away this row, okay, and shift this thing to that. So this will shift the entire data one row on top. So that means you are taking the Excel sheet. So let's consider for an Excel sheet. So submit your code here. So let's consider submit. Okay. So what does this shifting means? So shifting means you are just taking this first row, that is the topmost row, and then you are deleting that row. So yeah, that actually shifts the value on top. So it shifts all the values. So you have to shift that. So for that you have to do df.shift. So what you'll do, you will take the open price. Okay, generally we take the closed price, but yeah, we'll take the closed price, and we'll do some kind of shift. So by 1. So this will give me a data frame which will shift the value by 1. So the first value becomes 0 or none. Okay. So yeah. So close price first value should not be none. Okay. Yeah. Cool. So it not only shifts that, but it converts the value. I mean. Okay. All right. So it shifts the value in the below position. So when you do shift.1, instead of deleting this, it deletes this and converts this as a none. So what you are doing basically when you do data frame dot shift, you are just removing the data from this, and you are just deleting this. So yeah, I mean, how to explain that? Okay, so you are not deleting this, you are just shifting it, and you are insert one above, and you are just deleting this. So yeah, that is the kind of shift you are doing. So you are just shifting one below. So here you are adding one extra row and then deleting the last row. So yeah, that's what you are doing here. And using this df.shift, you are doing that. And when you do this close dot shift, it shifts the value. The first value becomes none, as I showed you that. As you can see here, the first value becomes none. And wait, let's. There is an issue with this Zoom. It does comes every time I use. Yeah. So whenever I shift this, so the first value becomes none, as you can see here, and the last value gets deleted. So that's what happens. And yeah, we'll shift it by 1, and then you can see we'll delete it by shifted value. So what we'll take the close value and we'll shift it by 1. And then you will have a data frame. So this data frame is basically so you take this entire thing, this returns you an data frame, and you just do dot head. So you will see, you will receive it, you will receive the ratios. So the ratio between t and t minus 1. So this ratio divided, this one divided by this, and this one divided by this. So basically you are shifting this value to down, okay, and then you are dividing this value by that shifted value. You got it, right? The point behind this, you are taking this entire row and then dividing it by the shifted value. So why is it done? Because you don't want to do some kind of looping through the table. If you do loop, you can do the same thing, but in looping is a very bad idea, because you don't have to loop. In looping, you are doing an synchronous task. In this way, you are doing asynchronous task, and the calculation is much more faster. So that's why you use shifting of columns to do some kind of operations on these columns, shifting of rows to do some kind of operation in these rows. So we are shifting it by 1 unit, and then we are just dividing it by we're dividing it by the close by shifted value, and then we are just we are subtracting it by 1. So this will give you the idea whether the stock price went up or down. So it gives you minus value, that means stock price went down. So if you see here that it went actually down. So close, if you see, it was starting like 319.80 and it stopped at 319.60. So it went down, and this negative value shows that. And when you see the next value, it shows positive, that means it went up. So you can see 319.65 and 319.60. This value is positive. And yeah, so in stock market you will see such ratios. I mean, if you see the stock market itself, let's show you the stock market. Which one shall I let's show you in Zerodha itself. Yeah, so basically you can get this ratios, right? So this kind of ratios are there, using which you can actually get an idea whether the stock market went up or down. So that's how you calculate these ratios, and you have to store this ratio in a new column. So you have to store this in as a daily return or only return. So because this is a minute wise data, so it's not a day wise return, it's a minute return or minute return. So yeah, so you are storing that data into a minute return. So instead of head, you'll remove this, and you'll remove this bracket, and you will do this. So basically you are creating one more column in this data set, that is data frame dot head, and you are just calculating the daily return. So that's how you calculate the minute wise return of that stock prices, and this will tell you whether the stock price went up or down. So yeah, that's really important to know. So one more return is there, that is cumulative return. Now you guys know how to calculate the cumulative return. You don't have to do much, because here you don't have to do any kind of shifting and all. So basically you take the first price and then do divide, and you divide everyone using that price. Now one more thing that comes into this play, how to access these values, right? So you want to calculate okay, so let's calculate the cumulative return, or the return from the initial first day. Instead of dividing this, so instead of dividing this value with this, we are dividing this value with the first value, that is this. So for first value we are dividing with the same value, so the cumulative return for the first day will be 0. So if you are dividing second value with the first value, so it will give you the second day's cumulative return, and the third minute's cumulative return. So this is known as the cumulative return, where you actually divide the price with the initial value. So how do you do that? Because you can't access the price of the you don't know how to access this price, right? So unlike arrays, you can't easily access this. So how to do this is very simple. This has many functions like iLock or only lock. So basically how iLock and lock works, So lock is like how to localization, I guess. I don't know what is the full form of lock, but using this you actually can access any one of this data or any list of this data or whatever you want. So you can actually access in however way you want. So with this lock you can access that specific data also. So I want to access the first data of close. So just to divide the all this close data with that initial data, so I want to access that. So I'll do ilock. So I'll do 0, comma 0. I guess this will give me the, okay, so there is an issue. What is the issue? Okay, I forgot the documentation. Okay, basically I have to watch the documentation. ilock. So how to access the data sets? So using lock and ilock. So you can go to the documentation in case you don't know how to use it. I used ilock long before, so I don't remember that. But yeah, using ilock you can access the data. So if you see that this is the data set, you can use ilock.0 to get the first row. So ilock dot brackets of 0. So you basically get the first column. So yeah, you basically get the first row, and this you get the first column, and you log 0, 1. So what do you get? You receive, yeah. So you basically get the first row and the second row, and you can do 3 for getting all those 3 things. Yeah. So I got the idea how it works. So basically you have to define the numbers also. Okay, too many indexes. So let's see how it works. So I guess 0, 1 should work. Ideally, it works. I don't remember why it's not working here, but 0, 1 should work. I have, like, I did it long back. Let's see what's the issue here. I'm accessing 0, 1, 0, 1, which returns 2. So yeah, that's correct. It should actually work. I don't know why it's not working. So basically it should work. If I do ilock, okay, I got it. So why doesn't it works? Because I am just doing ilock on this close data set. So 0, 1 doesn't work. So because this is already selected data, so now it will work because I initially selected the close value, and it already took a scalar part, and in scalar you can't put ilock. Now I'll do some kind of lock. That means instead of giving an integer, you can give it close. Close doesn't exist. Fine. So we'll access by integer itself, and we'll see we'll get fetch the first element of this close value. So 1, 2, 3, 4. Yeah. So you have to go 4, 0. So you can have to go 0, 4. So yeah, with this data frame.ilock, you can access the data, any one of this data. So how to access each one element out of this table? It's very simple. The first thing you have to tell is which row you want to access, and the second thing you have to tell which column you want to access. So yeah, so this works in a way. Row, column. So that's how it works, and you are accessing the close value. So that's how you access the close value. And I guess this is how it works for lock. Lock is just you, instead of writing 4, you just have to write uh, like you have to write this column name. So that's what the difference between lock and ilock. Don't get confused. What is the difference between ilock and lock? You can use any one of them depending upon your usabilities or your or your ease. So either you use ilock or you use lock, whatever you want. So basically I use lock because this tells you which data you are accessing. So that's how you actually can access the 0th element of the close column. Got it, right? So you basically can use lock or ilock. Ilock, instead of giving close, you have to give in numbers what column you want to select. So that's the difference between ilock and lock. So let's continue with this lock. Maybe I'll write ilock also, just to show you how to access that. And what we'll do, we'll create cumulative return. So data frame is already given here. So what we'll do, we'll just do cumulative kind of return. And yeah, we are accessing. Just to yeah. So I mean, you are using ilock and lock for accessing the data. Now the next stuff is like, how do you calculate the cumulative returns? You do ilock and 4 for accessing the close amount. Let's see whether both of them are equal or not, because ideally both of them should be equal. So it should return true. And it's not JavaScript, so it returns you true. So you'll take this value, and basically what we'll do, we'll just remove this shift. Instead of shift, we are just dividing with the initial amount, initial price, and then we'll do -1. This will give me this will give me my minute wise minute. So you might get confused, so I'll convert this min as minute cumulative return. So this will give you cumulative returns, and I hope you can now check the head, and we'll give you cumulative returns. So cumulative returns always after some time, if you see, it will be positive only, because in a longer run stock prices always increases until and unless okay, someone is texting me. How to change? Okay, so what do you want me to repeat? Can you tell me? Like I've just missed the context you are asking me to repeat. So can you just tell me what thing you want to repeat? And shifting. Okay, so basically shifting, I have already explained. Shifting means you are just shifting the data. So if this is the table, you are just shifting this table one below. So you just shifting it by inserting one above. So basically you are shifting the data. Right now it has 12, right? So but the data frame size should be same. That's the condition. You have to shift the data, but the data set size should be same. So delete the lowest row. So that's what you are doing. That's why the first element of the shifted data frame is none. So you are just shifting one below. That helps you in doing table, like if you want to do some kind of tables, if you want to add two tables and all, this helps you in like because it takes lesser time than going through each elements and doing some kind of calculation. So that's why we shifted the data and then divided with that shifted data. So that's what we did it. So we just shifted the data and created a same size table. So the size of the shifted table will be the same. Only the value will be shifted. That means if I show you as a so let me show you some example. So let's do a data frame shift and show you the shifted data. Shifted by one. So this will create shifted data, and now we will check the head. If you see that the shifted by one, first value will be none, and the second value will be the first value of the close. So 319.80, 319.80, and then similarly 319.860, 319.60, 319.65, 319.65. So it gets shifted by one, so that I can easily divide this to this. So that's why we are shifting it, and that helps in the calculations. So and like easily you can calculate the daily return by dividing this close by this. So this will give you the daily return and subtracting with one, and that's why you do the shifting and all. So that's why you are doing shifting, and it helps you in future calculation also. When yeah, so I'll show you some future in future some more example of this, but right now the only example is like you want to calculate the daily return. I hope this clears out your doubts, and yeah, how to change the value of a number with respect to row and a column. Okay, so that's a really interesting question. So how do you change that? So I hope this actually you can change it this way, I guess. And okay, so let's try to change it out. And you can see, I guess, the value will be changed. See, so using iLock or lock, you can change the value. It's similar to how you access the array in an array. So how you access an element in an array. So, but then in array you do brackets and you put your value of or the index values. So in array you are just using square brackets and putting the index value. But in here you don't have to. You not only have to put the square brackets, you have to use this command lock or iLock, whatever you want. For lock, you have to give the that column name, and for iLock, you just have to put the indexes, and then you will actually access that value, and then you can actually change it. So that's how you change it. But I don't want to change it because this creates a error in our calculations. So basically, I'll again import my data again and start from the beginning. So yeah, I'll calculate the daily return. So let's calculate the daily minute return and the minute cumulative return. And yeah, that's the meaning of cumulative return. And yeah, so okay, so basically okay, so basically I have given you an idea how to do iLock, lock, and doing some shifting and all. With this, I want to finish off, I want to wrap it up this tutorial. And tomorrow I'll explain you this all things. I'll give a little bit theory about this. I want to give it theory, but this is little, boring. So yeah, so next thing is forward fill or backward fill. So what is the forward fill and what is the backward fill? So this I'll explain today, and I'll wrap it up with this thing. Sometimes you see that the stock, whatever the trading is going on, the datas are not, so you have the datas like you stock datas, right? So sometimes your datas are really pristine because you don't receive the data and you have gap in between, right? So what you ideally can do, so this is the stock market price of any data, let's say SBI, and you are receiving data, and then achanak your network's issue came and you just lost the data, and you had a gap between these two, and again it started. So you had a gap between these two, and in between you don't know what's going on. So yeah, so it's in the stock market, so you can't actually pick what's going on in the future, and you can't actually do some kind of interpolations and get the stock prices. So that's why you can do either, you can actually create a line connecting those 2 points, or you can do a forward fill, or taking this value and filling the NaN values, or you can do a backward fill. So in that one, you take this value and do a NaN value filling. But then you don't know what will be the price in the future. So you can't do this one, and you can't also do the backward filling, because anyway you are in this position and you don't know what will be the future price. So in machine learning, in this future price prediction, you are always in a position in the past, so you don't know what is going on in the future. So you have to take decisions based on your past prices. So yeah, so you are just sitting here and you don't know what's the prices in the future. So that's why you can't do backward fill, because then if you do backward fill, that means you have predicted the price. Okay, so you just start doing backward fills and there will be huge jump, and you just predicted the future price, right? And if you feed into some kind of model, and that model will similarly do some such kind of absurd, like some kind of issues where it actually try to predict the future price, even though there is no way of predicting the future price. So that's why you have to do forward fill, or considering that position as a constant, and you just have to continue with the forward fill. So Monte Carlo simulations is some different kind of simulation. I'll explain you in later state. So someone is asking me what is the difference between forward fill and Monte Carlo simulations. Monte Carlo simulations are the simulation using which you actually do some kind of portfolio management. These simulations, for example, this some side I used to. Okay, so there used to be some. I used to do some kind of algo trading in my early stage college life. I used to do some kind of simulation. So this is a part of a simulation where you actually simulate through multiple stock market prices, and you just have to find out the optimized. Like there is some more like theory coming into this. I can't explain you properly, but yeah. So this thing is like, if you want to buy some stocks prices, so you can't directly go and buy that stock, right? So you have to do some kind of background check behind that stock, and also you can't only buy a single stock, right? So you have to buy multiple stocks, because see, if you are doing some kind of toss kind of uh, gambling, so if you are into some kind of casino and it has 60 tables and you are given 60 rupees, so you can actually do two ways, like lottery. Either you go to 60 table and put one rupee in each table, or you put 60 rupees in a single table. So for both the case, if you see the first case, the probability of you uh, I mean losing is like 1/2. Okay, in the case where you are actually putting 60 rupees in a single table, the probability is losing is 1/2. But in the case where you are going to each table and putting one rupees, the probability will be 1/2 multiplied by so yeah, so the will be 60. So 1/2 into 60. So yeah, the probability decreases so like 1/2 into 1/2 into 1/2. So basically it's power 60. So it decreases, and like yeah. So that's what I mean for portfolio management. You generally take multiple stock so like you take multiple stock instruments. So what is instruments? Basically you are taking like SBI, you are taking like, so SBI is an instrument. You are taking Tata Motors, that is an instrument. Tata Steel, that is an instrument. So you are taking multiple instruments instead of investing in a single instrument. So that way you are doing some kind of portfolio management, and this simulations gives you the optimized portfolio. So if I have risk appetite of 12 and monthly rupees of 1000, and if you submit, it will give you some kind of optimum portfolio. So yeah, let's wait for it to give you the optimum. I don't know whether it works or not. So it will give you some kind of suggestion based on which you have to buy a stock like you have to buy stocks. So yeah, I hope this gives you, like, I have only 30 seconds, so I hope this gives you an idea of all those things. Yeah, see, it gives you a stock portfolio, how much to invest on what all stocks. So that's the meaning of Monte Carlo simulation. And backward fill and forward fill is just you are interpolating the data. That's it. So I hope this gives you an idea. We'll see you up tomorrow. All right then. Bye. Good night. See you.